trading at its best.
So welcome to the Forex Weekly webinar today. I'm Mike Swanson, and I've got a new lesson today that I think you're going to enjoy. We've had a lot of people requesting some training on exits. So that's what we're going to be talking about today. Where should you put stops and targets? So I'm going to be teaching you why a small stop or a big target is not always best. And I'll be teaching you where not to place your stops and targets. I want to make sure that you realize that there's some methods that you're probably using right now that you have no clue why it's not working, and I'm going to show you why and why it's a bad idea, just so we can get that out of the way so that you can learn the right way to do it. That's where I'll teach you high probability methods for placing your stops and targets. So let's talk about why that small stop or the big target is not always best. Here's an example of a small stop. Okay, so if you think a small stop is best and you've got to keep your stops tight, this might change your mindset when you think about this, when you go to take your next trade. Okay, let's give an example here that if you had a trade that you opened with a half a lot, where it's worth $5 a pip, a half of a standard lot, and you have a 10 pip stop loss, a really small stop. Basically, you have $50 at risk, right? If the market were to hit your stop, you would lose $50. Okay, so let's look at another one. If you traded 0.1 lots and had a 50 pip stop, a much bigger stop, a lot of you would think, oh, I'm going to lose a lot more money. Well, you have the same amount of money at risk, $50. The reason it's the same is it's all about that lot size. And I've taught this in the past, and I've even built this into my Informer tool, a way to automatically calculate lot size for you so that you don't have to worry about if you need a bigger stop. But hopefully this basic example shows you that you should never think that you have to have a bigger stop, purely for lowering your risk in the market, or so that you're not losing as much money if you lose. That's not how it works. Okay, you need to get your account set up properly so that you can trade smaller lots and bigger stops if it's necessary for your strategy. Okay, you don't want to sacrifice a good trade that needed maybe a 100 pip stop because you think that's too big and you're going to lose too much money. All you need to do in those cases is reduce your lot size. Okay, now let's look at a big target example. Let's say you have a trade that you opened with 8 mini lots. So 0.8 standard lots is $8 a pip. And let's say you had a 20 pip target. Okay, so it's kind of a smaller target, 20 pips. Well, that would give you $160 profit potential. If you hit that target, you would make $160. Okay, now some people say, well, I've got to make a lot more than 20 pips to make more money. Well, look at this. Here's an example. If you took a mini lot on a trade with a 100 pip target, you only had $100 profit potential. You had less profit potential with 100 pips than you did with only 20 pips. So I just kind of want to open your eyes when you start to think about where you should put your stops and targets. You shouldn't base it on a smaller stop means you risk less and a bigger target means you make more money. I just debunked that for you here by showing you that you need to look at your risk management and as far as how many lots you're going to place on the trade. And then you're going to want to compare the two, your stops and your targets, to determine your risk to reward ratio. Because obviously the worst case out of all of this would be taking a 10 pip stop, a 10 pip stop with a 100 pip target. That's the worst, that'd be a really bad situation. So, you're going to end up trading, you don't want to be, I got it backwards, sorry. You don't want to be risking 50 pips to make that 20 pip target, right? The more risk you have out there, and the lower your risk to reward ratio, the more difficult it's going to be to stick with your strategy. I see a lot of people that will go out and make 10 pip trades left and right, profit, 3, 4, 5 times in a row, and then their stops are too big so that they wipe it all out. So anyways, we won't go into that, the psychology and things of trading today. The key is just keep a good risk to reward ratio, and I want you to be, as I go through this training, to be thinking about You no longer have to think, oh, I have to skip this trade because it needs a big stop. I mean, even if it needs 500 pips stop, you should still be able to take the trade with the same amount of risk as a 10 pip stop. Okay, so now with that out of the way, let's talk about where not to place stops and targets. You might have seen me use this example in the past, but this is really important. I want to give an example here that let's say for some reason you had a really strong counter trend signal to go short right here. Okay, for some reason you were going to go short right here. Just play this example with me. If you went short right here and you were trying to figure out where to put a stop, where would you normally put your stop? Okay, in the past I've done polls and I've done a lot of research with our members in our group in these webinars, and I've found that the majority of traders say they would put their stop just above this swing point. They'd go 5 pips, 10 pips, 15. It's always just a slightly different answer, but the idea is they're thinking you put it above a swing high when you're going short. Okay, so if you got your stop up at somewhere in this area, that's not a good place to put your stop. And here's why, and you've probably seen this a lot. Look what happens when the market continues. Okay, so we had our short trade, remember right here. We had our stops, we're saying somewhere up in this area. Look what the market does, and it does this over and over and over. It pops up, stops you out, and then goes the other direction, and now you're sitting here kicking yourself that you didn't use a bigger stop, right? Because you were right on the trade. This was a great counter trend trade, huge profit potential. If you used this stop loss method though, you got hurt. So that is a place you don't want to put stops and targets. You don't go put them in just above a swing high or just below a swing low, okay? Because the market is naturally going to find, going to naturally be almost magnetized to go to those areas to find liquidity before it returns in the same trend direction or the direction that it planned on going. It needs to test and find orders. That's what the market does. That's how the market flows and how it works. So this is an example where it's really crazy when I see it. It's like 95% of traders are doing it this way. They're putting stops here, getting stopped out instead of realizing it's fine to have a bigger stop up in here. Okay. So anyways, that's where you don't want to put stops. Now let's talk about where you do want to put stops. Some high probability stop and target methods. Okay, what you're going to want to do is locate true support and resistance. True, I'm going to show you what that means. And place your stops and targets above and below those areas. Okay. The way we do that is using the market sentiment tool. And there's also another resource on Dukascopy that offers this. But we've built in true market sentiment into our little free tool. And I'll bring that up here in a second. But this information tells you exactly where people have stops and targets. Okay? And it plots it on an image here for you. So this is our tool, Informer. I'll give you a link here in a minute to download it if you don't have it already. But this tool on the Market Sentiment tab, you select your pair and a time frame that you want to look at. I've got it set to a month, so it's showing me a month of data. And what this is this is just a snapshot provided by a broker that's connected to a large pool of liquidity providers. So we're seeing a good chunk of the market, and we can assume that this is what the majority of the market is doing, the retail traders. So once you get this up, you can see it. It's a snapshot. It's an image. So we don't have a way of telling you specifically what price levels these are at, but it's basically an image, and it still gives us a lot of valuable information. Okay, so we're on the net buy-sell order chart. And the reason we're using the net is because we want to see where the majority are at. Okay, so when you see these dark areas of red or orange, those are sell limit orders that will cause true market resistance. And when you see the green, those are true buy limit orders, true support to the market. Now this does not mean that it's never going to break those levels, because there's only so many orders there. The market at any time, if it's really strong, can push through those. But what you see most of the time, this is why it works, is it doesn't have to work 100%. It works, even if it just works more than half the time, we're good. but it works much better than that. And you can see here was all these really strong buy orders, right? The market came down, found support right there. It came down, started filling those orders, and then bounced back up. Then it found all these sell orders. And yeah, it was pushing through them really strong, but then it bounced back. Okay, so these dark areas that you see on the chart, these are where you want to be putting your stops, just beyond those. So let me give you an example. I'm going to take the same example of just putting in a trade on the chart, and we'll look where you would put your stop. So let's draw, okay, let's say we took a buy trade for some reason on this decline right here. Maybe you thought it was going to bounce off of this support, and the support was going to hold. Okay, what most people did, like I showed you in that other chart a minute ago, most people looked over here and said, okay, you got a swing low right here. I'm going to put my stop right down here. And look it, that's what everybody did. That's what all these dark areas are. Okay, that's everybody thinking that the market's going to go down there and you know, that's where they should get out. So everybody's got their orders right there. You can clearly see it. You can see they went about 20 up to about 20 pips away from that swing low. You don't want to go there. The market's going to bounce. We can already see it did. It's going to hit those orders and go. We want to go just below those orders. You know, there's even another little block right here. We want to put our stop just below those. Okay, and preferably we like to see it in this whiter area. When there's white area, it means there's, you know, there's hardly any orders at that point. Okay, so if you were to put it even down here, you would have been perfectly safe during that pullback. Okay, when you took that trade, you'd have your stop here. Everybody else would have got stopped out and bounced up, and now you're able to get this profit up here. Okay, so that's where you put your stop in this example. Below these orders, and preferably down this white, or just below at least the next level of major support, that major green area. Okay, now once you've done that, you got to figure out, okay, where do you put your targets? Well, the target should be determined by where the red area is at. If you're buying here, like we showed, if you took a buy trade here, you said, okay, stop down here, you're going to want to put your target just before, so it's the opposite for targets. You want to put it just before those major levels of resistance. Okay, so these levels can change over time, and you can adjust them. But when I'm watching the market right here, you know, this could have been news that just pushed it right through regardless. But anyway, I would say, hey, there's a block of sell orders here. If I'm not going to be there to watch, I will just put my target there and leave it, knowing that there's a good chance it could bounce. Okay, if I was watching it now, however, what I like to do is watch it enter into these zones. If it struggles to push through there, then I want to get out. Okay, so if I'm watching it and I'm able to keep my target open, I can watch it and say, okay, it's clearly finding a lot of buyers to be able to push through this, to be able to push through here. So I'll keep holding on to it all the way up until it finally turns. When it finally turns here, it means that the buyers were exhausted. They struggled to push through all those orders. They finally got through them, but then they didn't have any more momentum. So when that's over, then you can go ahead and exit. Okay, now let me give you an example, because I know a lot of people say it's easy to look at the past and make those decisions. Let's look at the current market conditions. Let's do that one more example of the current market. Okay, if I were going to let's say I was going to take a buy trade right here. We'll do it both ways. I'll show you a buy and a sell. Okay, if I want to buy right here at the current price, what do I do? Because obviously we can't see what's going to happen. Well, we can look directly below. There you go. Block of buy orders. Don't put your stops below right here like everybody else. This is everybody else saying, well, where's the next level of swing low, or swing low for this to put my stop in. Everybody else looked over here and says, okay, I'm going to put it 5 pips below. Okay, this guy put it 10, 20. You got some people up here 30 pips. They're all putting their stops right there. Okay, the market knows that, and there's a good chance it's going to come down here and nail them and go back up. So what are you going to do? Well, you could go in this white area here. I mean, it's kind of patched up now, but you could basically just go just below those buy orders, since there's no other white areas directly below. And you can always move your stops, right? So if this changes, you can always tighten your stop or widen it if you need to a little bit. But anyway, go right here. Go just below those orders even. As long as you're outside of these orders, you have a high probability of surviving a stop run. There's a good chance it'll come down, take the rest of these guys out, and go up. See, these guys over here, they didn't know how many pips to go. They're sitting here counting pips from the swing low, saying, should I go 10, should I go 20, 30, I don't know. So there is no magic number. The magic number is go just a little bit further than the majority did. And the way you see the majority is using this chart. Okay, so the majority are right in here. You're going to go outside of those guys. Now, if the market comes down and hits them, you survive the move and hopefully make some profit on that. Now, for your target on this trade, if you're buying here, is going to be, let me get that tool back up. Your target obviously is going to be just before the major resistance up here. So if you're buying here, your stop is here, and your target's up here. So that's a nice, it's a nice trade, good risk to reward. Okay, you might be risking 100 pips, but you're going to make 150. Now I'm on a monthly chart. Now, so if you don't want to trade longer term like this, we can go to a lower, period. But you can see that this is how you do it live. If I were to take a trade right now, if I wanted to buy, if I had a signal from one of my systems, I could look at this information and base my stops and targets off of it. Now let's do it the opposite. If you were going to sell here, let's say you felt like that momentum's really going hard down, you want to sell right here. You got to remember it's a little different when you sell. You don't put your stop here. Okay, you don't put it before like you would with a target. You put it above. So there's all this major levels of resistance. To be safest, you'd want to go up here. If you want to go a little tighter, you could go in that white area. Okay, but that's putting above the major resistance. Okay, now for your target, it looks like going short, you don't have as good of a risk to reward potential. You can see for a target, you'd want to be just before that block of buy orders. So you don't have a whole lot of room. You have to have a bigger stop to get a smaller profit so far. Now things might change over time and you can start to tighten your stop, but that's how it looks right now. That's how you would want to do it. Okay, let me hurry and do one more example, switch down to the 24-hour, show you the shorter time frame, how you would do it here. It's the same exact way, but let's just look at where things are more, like a 5 or 15-minute chart, more fast-paced. Okay, so you have a different block of orders here. Okay, you've got a block of sell orders. Now, a block of sell orders would cause continued momentum, so you don't put stops below those. You got to go below the green if you're buying. You need support, and support is going to be green when you're buying. So you'd want to put a stop actually right here. Okay, and a target, you don't have a dark red area till way up here, but if you're looking at it that way, you could say, okay, put my target just before the orange and my stop just beyond the green down here actually. So again, you see, you don't have right now is not a very good looking situation to go long. There's a lot more resistance to the upside. So if you were to go short, however, if you were to go short, you'd have your stop right here and your target right here. So it's about a little better than 1-to-1. Now, I'm not suggesting that you say, oh, I shouldn't go long because there's not a whole lot of risk to reward potential. It's just, you might want to be a little more careful on the trade knowing there's really strong resistance in your way, and you can just watch it. Remember, you don't have to say, hey, I have to get out just when it gets there. Watch how the market reacts to those levels. Okay? So this lesson, I hope, will help you guys determine better places to put stops and targets than just hey, look at the swing low and put your stop down there. It doesn't work very well doing it that way. You get stopped out like everybody else before the market continues. So let me get you a link if you don't have this tool so you can download it. And then that way you can see exactly where those levels are at yourself. So like I mentioned earlier, the Informer tool is a free trading tool. It has a lot of features besides the market sentiment. It also has these news alerts, so you can make sure you don't get caught in an unexpected event. You can set it and forget it, and it'll always remind you. If you want it 10 minutes before the news, whatever you want to do there, you can play around with that. It's got built-in trade execution, so you can trade your own accounts through it and manage multiple accounts got money management built in, risk management, all kinds of bells and whistles you can play with when you get it downloaded. Money management that actually has the ability to turn losing systems into winners. So that we're just about done with it. It's called Risk Hero, and it will automatically determine lot size and has the potential of turning losers into winners. So you can download the tool at tradewestforex.com/informer if you don't have it already. And I'll go ahead and post that link here in the chat as well. Okay, so there's the link in the chat that you can click. And I'm going to go ahead and get into Q&A here now. But take this lesson, study it. We'll get the recording up. It's very, very helpful to have a good place to put stops. I mean, you could have the perfect entry and everything was great, but you get stopped out just slightly before it went in your favor, and that can be so frustrating. So I know if you practice what I've taught today, it can make a huge difference for you guys.